I mean, so we're certainly quite bullish on continued wireless growth. Obviously, data is growing. Consumer appetite is just insatiable for wireless data. So we see a tremendous opportunity in the networks, the infrastructure, the components that support data. We very much believe that as we get into a data environment, there will have to be a transformational shift in the way that networks are developed, in the way that networks are managed, the equipment that supports networks. And so whether it be DAS, femtocells, picocells, pick your flavor, or small cells, we think is an area of quite a bit of growth and intrigue.
I'd echo a lot of what David said. The one area that we're focusing on that may provide a little bit of a different angle is really on the carrier side in terms of what do you do with all the information that's being gathered by all these devices. You know, we've all talked about infrastructure demands. We've heard all day about what that's doing to networks, and a lot of the discussion's really been about what do you do to alleviate that congestion on the networks. We've got a company that provides business analytics to certain carriers globally, and the question is, you know, we're collecting 8 billion call data records a day, and that's everything from network management to you know, finance and revenue assurance and those types of things to customer behavioral issues. So you know, a big issue and opportunities that we see really on the software side, tools for the carriers to help analyze, sift through a lot of the data that these additional devices and additional customer user experiences are putting on the network, and what does that mean from a revenue perspective, from a marketing perspective, and from a network perspective.
We'll put about 190 to about $220 million of capital to work this year, and across that CapEx spended, we will probably put about a third of that into international. That's an area where we've spent a lot of time. We see that some of our customers, particularly Claro, which we've had a great relationship with in Puerto Rico, we found a lot of different territories where they need help, and they're now open for business and allowing us to put our balance sheet to work for them. So that's provided a very good opportunity. Domestically, we continue to find interesting acquisition opportunities. We recently completed a transaction with Cricket where we purchased their towers. That was a good opportunity for us and for them. We're building out DAS systems primarily in the urban core, focused on indoor venues and focused on large chunks of office properties where we can amalgamate and put together about 4 to 5, 6 million square feet. We're still very aggressive in the rooftop business. We believe long-term in the urban core. That's where the subs are. That's where the MOUs are being put to the test. That's where networks are congested. We're still building towers. So across all the different facets of the wireless ecosystem, we're putting CapEx to work this year, and purely focused on assets, as David said, that are reoccurring in nature, that withstand different cycles that we see in wireless, and staying very clear of businesses that are service-oriented.
But things are moving very fast. And for our business model, you know, things that are moving very fast, sometimes it's challenging. Because in our business, what do? It's like the guy who is showing up at the train station and trying to decide which train to take. And the trains are moving very fast. And what we do, we make a bet on technology, or we make a bet on an application. I think one of my colleagues said earlier that one of the things that he's looking at is the test of time. You know, what's relevant today might not be relevant tomorrow. You make an investment today in a product that might be on application that might be ready only 2 or 3 years from now. And that's very difficult.
Yeah, I think that really goes to probably, as you said, the composition of the panel. I mean, there are plenty of VCs out there that play at an earlier stage of life. You know, David really doesn't play there. I don't. To some degree, maybe a little earlier, David here, but not much. You know, that's a binary world. And that's a world where you need sample size. You throw 10 and you hit 2. We're more small market growth buyout type people, and so we don't play in that world. But there are plenty of opportunities there. They're just earlier on the risk return curve.
So before joining Comcast Ventures, I was at a company called Flarion Technologies, and in 2004, we demonstrated and commercially deployed a live mobile broadband network capable of delivering 1.5 megabits per second of sustained throughput at 80 miles an hour. Technology worked. We deployed it commercially. We went to the operators, and the operators said, wow, this is great. What do we do with this? Why would people pay for this? How would we use this? And it was just that resistance because the market just wasn't ready for it. The iPhone obviously hadn't launched. Primarily, these were laptops with air cards. Laptops didn't have embedded wireless radios in them that required it. So built a remarkable technology. Luckily for us, we had Qualcomm come across and realize the value of the IP, and they paid quite a bit of money for it. But it really comes down to timing, and we had raised $180 million to build that business. So it was a very significant endeavor. We delivered the product. The market just wasn't ready. The carriers weren't ready. Consumers weren't ready for it. There was just no demand.
Sure. I think for us, what drove us to look at international properties and opportunities was largely that we couldn't get the return on expected capital here in the U.S. in certain of our activities. So we began looking into markets where we found familiar customers and familiar faces, where we had relationships, and we could replicate the U.S. tower model in those countries. And not every country you can replicate the investment thesis that we've executed here. So the first part was staying true to our thesis, and we have sort of 4 critical cornerstones to that thesis. And if a country vetted on those 4 criteria and the transactions vetted across those 4 criteria, we would press ahead. But prior to even getting into a transaction environment, we started working on a geopolitical risk matrix about 2 years ago, and we spent about 6 months exploring all of the different countries in this hemisphere. And where we came out was there was about 6 countries that passed the criteria that we felt were relevant for making an investment in those countries in the wireless infrastructure space. And that really put outside of that matrix about 14 to 15 countries. So pretty heavy screen, spending a lot of time. A lot of that's focused on political and currency, to be honest. That's really where we see the biggest risk factors. Some of our customers are willing to do dollar-based business with us in those countries, which is very helpful. And in turn, some of those countries do commerce in dollars as well. So that's also helpful.
You know, we find ourselves getting priced out of a lot of opportunities within the States. And as Marc suggested, you know, the first thing is, where else can you go? If you have a team and you've got a model and you can vet the things internationally, that's where you go. The issue becomes, as Marc clearly stated, what's your risk and your return? And I think, you know, because if you've got a pile of money, either you got corporate money, you got a backer that wants to put capital out, you tend to start shrinking your return expectations, and that premium you look between international and domestic tends to start to get squeezed, and that's where it gets dangerous. We had one of our very successful investments in a previous fund as one of the largest cable operators in Brazil. And I will tell you, you know, when the macro environment, the political environment, the currency environment, all those things line up with your ability to execute, you get out of town because you do not know whether it's going to be 3 months or 3 years when you're going to get that opportunity again. And that's no criticism of those countries. That's just, you know, that's empirical data. So your exits become a lot less, you know, you just find fewer and fewer opportunities when you're going to want to be able to get out.
You know, we have a new mantra. It's actually not a new mantra. It's an old mantra in our group, and it's called return on headache. And it actually germinated from an investment in Mexico. And we had built out about 7 or 8, I wish. At least you can take that with you, or the remnants. But, you know, what we found in Mexico is we built out about 7 markets, and we were doing quite well. Business was flourishing. We ended up selling the assets and making some money, but the return on headache and some of the things that happened along the way were things that, you know, you could write lots of stories about, but you just don't want to speak about them. So, you know, as you start looking at some of these things, it's great to have someone like this guy over here who speaks the language, understands the culture, and can make things happen. But without a good roadmap and without a great leader who understands the markets that you're going into, the return on headache may not be worth the actual dollar return that you can generate.
Well, maybe turning more to the domestic market. You know, obviously in the U.S. here, mobile broadband is a huge business. There are also some new players trying to get into the field, actually build up their own networks. But again, everybody knows it's a very capital-intensive field to get into. What's, I guess, your guys' general view of some of these new entrants and the possibility of them acquiring the funding necessary to really build out networks that are going to compete with some established players who already have you know, robust networks up and running? I mean, it seems like perhaps an uphill challenge, but you know, what's, I guess, the general view of you know, investments in some of these new carriers trying to come to the market?
There's a good point, though. They're sitting on spectrum. They're not building it. Okay, they understand that to build a nationwide network or to build an overlay on top of their existing footprint is completely infeasible. Okay, everyone knows in the room that have to build 20 to 40,000 cell sites, which they can't do. They could do, but it's not the best use of their capital. What they do know is that there are other networks that they can continue to wait, sit on the sidelines, let other people build that infrastructure, and then they can go and buy that spectrum and buy capacity on a wholesale basis. And it is far cheaper for them. They've run the models, they know that. So time is on their side. And what sets up for is a predatory environment, as David hinted at. Who wins? The equity holders or the bond holders? Well, in Light Squared and Clearwire, it's probably going to be the debt holders. Time has shown that that's usually the case when you have a new entrant that's trying to build a nationwide network under the current environment. It's very difficult for both those two operators to have commercially viable standalone retail networks. Not possible. Neither of those carriers can build out commercially viable retail networks nationwide to compete against what will be the big three.
Yeah.
So what ends up happening is equity gets crammed down, debt holders win, vulture debt guys come in, Comcast waits on the sideline, they can pick who they want to buy capacity from. It's a smart play for them, they can sit on spectrum. But until the FCC gets involved and mandates that spectrum gets put to work, the spectrum ends up getting mothballed and it's used as trade bait. So that's not really promoting national broadband, is it?
I would just say, having lived through a couple of recessions, you always have to be pragmatic about the economic climate, political climate, and be realistic about the future and the projections. And we could all debate whether we're in a bubble right now or not, but the reality is that markets fluctuate and they're cyclical. So if you're looking at an investment that depends on continued growth of housing, as an example, you have to take into consideration whether the current trajectory is sustainable or not. And we certainly think about that. We're not economists at the end of the day. We don't have that level of insight, but we certainly take it under consideration.
Just to add one thing, we are in a bubble. It's being maybe one of the older guys up here, been through it before and a couple of times. It's clear to me. We're looking at small, mid-sized businesses, growth or buyout investments. And I'm hearing revenue multiples, and it's back to per clicks, and it's just not the internet stuff. I mean, it is really, really frothy out there, and we are much more sellers of businesses than buyers of business today because of that. Is it because we think the world's going to end tomorrow? I'm not even sort of looking at that far. I just see people paying stupid prices for nice businesses, but really discounting, what's going to happen in the future, and got their rose-colored glasses on.